Hey guys, we are live. We are live. Welcome everybody. Welcome to Mortgage This is the second workshop where we got many workshops. So it's 6 p.m. We're going to get started. And this is Don Dickson of Cross Country Mortgage. We're going to talk about mortgage business.
From other agents.
That's right. You know, the things that we learn at hondros and are basics for your exam, but this is a step up. So even if you're a seasoned agent, we're going to go over different types of loan programs as well and how they might fit, you know, a client that you might have. And it's just, you know, you don't have to be a mortgage expert, but you want to make sure you know enough when it comes to helping out your clients. So we're going to cover all of that, much more. All right, go ahead, Don. You are live.
All right. Thanks for having me. Just wanted to do a workshop for you guys to help educate you a little bit on mortgages, just enough to I go to Vegas once a year. Big college football fan, NFL fan, diehard Bengals fan. And I've been in the mortgage business. My wife pointed out to me this week, it is officially half my life this year. So I'm 42 and it's been 21 years. So time flies. So that's a little bit about me. I know a lot of you guys. I don't think I never really got to tell you about me. So that's about it. Work for Cross Country. Cross Country was founded in 2003 up in Cleveland. They're the official Cleveland Browns sponsor. Yeah, I'm not happy about that either. Yeah, but that's good. You know, so they're up in Cleveland. They're a top 5 retail lender. They were the number 1 mortgage company in purchases in Ohio last year, 1.3 billion. So we have a big presence in Ohio. Licensed in 50 states and Puerto Rico. I'm personally licensed in 25 states, I think. So if you have any friends or family members looking to move or have questions, let me know. I can help out. We do have 120 different products. I'm not going to go over all 120 products today. We'd be here for 2 weeks. So just going to touch on 4 of them. And these are the ones that most of your clients, if not all, are going to fall under. And these are the ones where I want you to learn just enough about each one. So when your client asks you those questions, the simple questions, you'll be able to rattle it off. Really basic stuff. There's conventional loans, FHA, USDA, and VA. Conventional loans are going to be people that usually have the better credit. First-time home buyers, you can go down as little as 3%. There's fixed and adjustable rates. Max loan amount's going to be, I think, $726,000. Anything above that's considered a jumbo loan. Jumbo loans are a different type of loan, but we do those as well. So that's a conventional loan. FHA is a government loan, as little as 3.5% down. These are the loans that if your client has some credit issues, these are the type of loans you want to look at. And I'll know more once I look at their specific scenario. Flexible credit requirements, you can go down to 500. Anything below 580, you're going to need 10% or more down. So if you're like 515, you could probably do that if you're putting down 20 or 30%. But if you have really bad credit, but a lot of money to put down, we might be able to do something for you. Then we have USDA loans. USDA loans have 100% financing available, and there's some geographic restrictions, meaning they're mostly rural. So you're not going to find a USDA loan on Polaris. You can't, in a city. It's going to be more rural areas. They have debt to income restrictions. They have like if you have a family of four, let's say husband and wife, and let's say there's a 18-year-old child that lives there and they work, we got to take their income in consideration. So it's a little bit longer process. So I do recommend 45-day contracts on USDA loans. When you're showing a client a home, if they say they want a USDA loan, as an agent, you want to make sure if you're going to go show them a home that it's USDA eligible. And then finally, we have VA loans. These are going to be the veteran loans. Same thing, up to 100% financing. They also don't have to pay the PMI. So there's no PMI, 100% financing. With VA, they have a funding fee that they can roll into the loan if the veteran's not disabled. So if they are disabled, there's no fee. They waive the fee. If they're not considered disabled through the VA, there is a fee that is rolled into the loan. That fee is a certain percent, and it depends on how much they're putting down, if it's their first time using the VA. So that's more in-depth information, but that's just the basic of all four of those programs.
Can we dive into the basic programs more?
Yeah, absolutely.
Very good. Okay.
Yeah.
So when it comes to conventional, when we have a client that they're wanting to get pre-approved, what are some pros and cons with a conventional loan?
So
for a realtor, let's think like what's best for a realtor.
As a realtor, I mean, you tell me, I don't think there's any negative downfalls on a conventional loan when you're that's a dream for an agent. Cash is a dream, obviously, but if it comes to financing, a conventional is going to be grade A.
And why is that?
Well, because that means they have good credit, they've got money to put down, and they're just smoother. The appraisal on a conventional loan is not as picky as FHA or VA, like chip paint. If there's stairs missing I had one last week where the back stairs were a little off and they want them to fix it for FHA. So you're not as strict with appraisals on conventional, better credit, more down payment usually. So conventional, there's really no cons on the conventional side.
So when you say appraisal in an inspection, an appraiser does an inspection, but it's very light inspection.
Yeah, it's different. Yeah. So as a lender, you get your clients will do an inspection. Okay. I don't want to see that inspection as a lender. That's something between the seller and the buyer that they handle outside. The appraisal is what we obviously care about, and we communicate with the appraiser on that. So they don't do an inspection like an inspector does. Like they'll go in, I think they'll turn on the water, see if it works, hot, cold, turn the AC on, the heat on, basic stuff like that. And then they'll look with their eyes if there's any issues. I mean, if they see cracks in the foundation, that's going to be a problem. That's going to be brought up on the appraisal, and then the underwriter's going to see it. We're going to see it, and we're going to ask for more information on things like that. But on a conventional side, the appraisal is usually quicker, easier. the whole process is just usually smooth. And now again, the FHA, USDAV, it's all smooth. It's all a smooth process. You just might have to jump through a couple more hoops as a buyer, you know.
Okay, so so if we have a client that has good credit and they have decent down payment, are you suggesting a conventional loan for them?
Yeah, I am. Absolutely.
Why?
Yeah.
Why
Well,
would that be?
with FHA, I don't think I got into that too much, but with FHA, they have mortgage insurance. It's the same thing as PMI, no matter how much money you put down. So FHA, I told you if they have bad credit and they have to put down 20%, let's say, we'll get them a loan with FHA, but they're going to have to pay PMI insurance on that FHA loan. On a conventional loan, if you put down 20%, you don't have PMI. So on FHA, you're going to have PMI for the life of the loan. So most people, what they'll do is I'll tell them, hey, I can get you a loan. Let's do an FHA. That they'll ask about the PMI, and I'll tell them you have to have it, but then get your credit where it needs to be to do a conventional loan, and we'll refinance you into a conventional loan, get you out of the FHA loan. FHA is great for first-time home buyers or people that have shaky credit.
Okay. So and if anyone at home, we are live. If you have any questions, feel free to put them in the comments, and then we'll share them to Don. So don't let me take over your thing.
No.
So if you have a buyer that maybe has great, decent credit or whatever, but they want to buy a house that is a little needs a lot of work.
Yeah.
And they want to do an FHA loan. Will that be a problem? Because the appraiser is going to go out, like you mentioned. I personally had a deal 2 weeks ago. We had to put a handrail up.
Yep.
We had to paint the garage door. It had chip paint. So,
right.
So if we have a client that wants to buy like a fixer-upper, because people who typically go FHA route, probably maybe first-time home buyers, and they don't have a ton of cash, right? And they might need a little older home and things like that. Is that something that if they're FHA only approved that we might want to warn them? Or maybe not do a fixer-upper?
Well, not necessarily. Just depends on how much of a fixer-upper that home is. That's a conversation I would have. The client would mention something about it, obviously, and then if the agent doesn't ask me about it, I'm going to ask the agent. I'm going to call the agent and just say, hey, how does this house look for an FHA loan? A lot of times you guys will talk to the listing agent. Maybe they've already had somebody try an FHA loan and it was denied. That's something you'll want to ask. But as a lender, I'm going to ask those questions, and then I'm going to let the customer know. And it's going to depend at the end of the day. Ultimately, depends on what the appraiser will say to us and what pictures he sends in. I had one not too long ago where the appraiser sent in an appraisal as is, came over to us. I looked through the pictures; it looked fine. And then the underwriter just had some additional questions and wanted the appraiser to go back out there, take more pictures. So if you run into some issues, again, you just have to jump through a little bit more hoops. But if like you said, the one where they had to put the handrail up, do some paint, all that stuff has to be done before closing. Like you can't say, okay, well, we'll do that, once we get in, or let's put an escrow hold back for the buyer to do it when they get into the house. That's not going to happen.
I was just going to ask you, say the appraiser, the FHA appraiser says, the FHA appraiser says, oh, you got to do the fix the paint, fix the stair rail. Yeah. But the buyer's like, no, it's fine. Don't worry about it. I'll handle it later.
Yeah.
Will the bank approve that loan without it being repaired?
No, the bank won't repair it. Or the bank won't approve the loan without them being repaired. But on the positive side too, is like I try to tell my buyer, the appraisal's subject to repairs, okay, but now the seller knows that, and so the seller has an initiative to get the stuff done, because if not, and they decide to just walk away, they have to disclose that there's these issues and they have to be fixed anyways. So
who typically pays for the repairs if they need to be done?
The market dictates that. It depends on how motivated the seller is, how motivated the buyer is. Sometimes you guys can come together and agree like 50-50. Sometimes the the seller will do it. If there's any concessions where the seller said, hey, we'll give you $3,000 off the fees, maybe they'll back that down to zero and fix the issues. That's really where, as an agent, your area of expertise is going to come in, and your negotiating skills are going to, and I'm all about trying to help. So let's both get on the phone and let's try to tackle this and figure out the best way it's going to benefit our buyer to help them get that house, but also not have them pay for everything.
So it really doesn't matter as long as it gets done.
Yeah, as long as it gets done. Yeah, absolutely. And I have this next thing is that this is a mortgage basics, which you probably can't see too much on there. So let me bring it up on this. So if you want a copy of this, email me, text me. I'll send this to you. This is great to just print off, put it at your desk, take a look at it. This will it's like it says, mortgage basics for conventional FHA and VA. Talks about minimum down payment, the occupancy type, PMI information, ratios, child support. I mean, it's got all kinds of just fingertip information that, if you study it, you'll know it really easy. So if you want a copy of this, let me know. I'll email this to you.
Yeah, if you want a copy of this is a great handout. It's hard to read on live and even up on the screen. But if you put your comments below, or Don could, and put your email, and Don, you can email that out to him if you want to do that.
Yeah.
Thank you.
Yeah. Sorry. Okay. That was the mortgage basics I was showing. All right. I want to also kind of go over the pre-approval process. I think as newer agents, you're eager to please people, and I'm all about pleasing people, but a lot of you have full-time jobs, families, hobbies, things like that. The last thing you want to be doing is running around showing people homes if they can't get a home. You're wasting your time, your money on gas, and then you're getting their hopes up. So highly recommend doing a pre-approval. And the way that looks is, once you have I get a phone call either from you or the customer. You call me and I tell me to call the customer. We have an initial conversation. In that initial conversation, I'm taking 30, 45 minutes to get to know who they are, what's important to them, why are they moving, where do they want to move to, what kind of money do they have to put down, just getting to know them, letting them know that the buying process is not as scary or as stressful as they might think it is. So I really want to put them at ease. Once we get past that, I explain to them that I'm going to send them an email. And at the bottom of the email, there's an apply now button, a big red apply now button. You can't miss it on the signature. You click on that, and then you take about 15 minutes, fill out the application. You're going to be prompted to upload some documents. I do advise them to upload the W-2s, pay stubs, etc. And then once the application is completed, I spend some time pulling their credit, looking at their specific situation, and kind of guiding them on what we're looking at as a bigger picture. I'm really big on having them fill out the application and look at their specific situation. They can ask me questions all day long. I'll answer them. But until I know their specific situation, we're just talking about what ifs. So it's important to have them to fill out that application, see how serious they are for you, for them, and to kind of see what we can do. I go through if I get a customer that has a W-2 job, been there for 2 years, they don't have a lot of bonuses or overtime, I can drum up a pre-approval letter pretty quickly. If I get somebody who's got tax returns and been at the job hopping, things like that, might take a few more days, gather a bunch of information. I like to package that type of loan up and send it to an underwriter to have them review it before I have you going out there and show them homes. So that's very important to kind of get to know your buyer. When you do talk to them, get to know them a little bit, ask them what their employment looks like, if they're gainfully employed, self-employed, and then we can set the right expectation up front. And then if I can't help them, I do put together a plan. I mean, I look at their credit, let them know, what issues we're facing, and then put together a plan and see what we can do to help them get to home ownership. I'll follow up with them, once a month if I have to. And then obviously, no matter what, if I can or cannot help them, my next call, as soon as I get off the call with them, is calling the agent, calling you, and explaining what our conversation was, good, bad, kind of what it looks like. So we're all on the same page.
So we have a client that's talking about possibly buying a house. We kind of warm hand them off to you, a loan officer. And then, so what are some things that we can do as realtors to try to like warm them up and say, I'm going to have you talk to Don, but these are some things that he's going to need from you. What are some things that we can do as a realtor to like warm hand off to you and set it up so it makes your life easier?
I mean, not necessarily just my life being easier, but I think, as an agent, you're also like a therapist. These people come to you, and I mean, a lot of conversations I have, everyone's freaked out and they're worried and they're scared. And so taking the time to get to know them, I know that's really important to them. And then whether it's me or if you have a relationship with another lender, I find also like I like to work with agents that don't look at these clients like dollar signs. These are real people, and we have a goal to get them into their house. So they can see that, they can sense that. So, if you say, hey, listen, I know Don and I trust him. I know you're pre-approved with Chase. That's a large bank. I don't necessarily, that's great, but have a conversation with Don. I know him, I trust him. I've done deals with him, or Steve, or whoever it is. If you have a relationship with someone you trust and you mesh well with and you click with, you're going to need that throughout the process, not just the pre-approval process. I mean, you want somebody that can answer the phone. I mean, I've talked to some of you. I mean, I've talked to Heather. I mean, if you text me on a Sunday at 8:00 at night, I'm going to respond. So not everybody's like that. Not everybody, will respond like that. So you want to make sure, because these people work 9 to 5 normally. And you want to make sure that if they have questions that you can get a hold of them when they're available. So, but as far as like, making it easier for me, I just nothing really. Get them on the phone with me, or let me call them, or have them call me, and let's see what we can do. But for you as an agent, I would say, and you probably already know this, just talk to them, have an initial 30, 45 minute call. You don't want to say, you get a phone call from a customer, oh, are you pre-approved? No, we'll call a loan officer and then let me know. Obviously you don't want to do that. Get to know them.
So there's nothing they need to provide to you to get a pre-approval?
No, I mean, if the more information you give me, the better. I'm going to get to that information anyways with the client. So, I mean, I've been doing it long enough to know what kind of probing questions to ask. But any information you have, share it, because we're on the same team. So yeah, I mean, if I have agents I work with, they'll call me up. Hey, they said their credit's dinged up a little bit. Just wanted to give you a heads up. Great. I'll look at it and let you know. But other than that, that's kind of where we're at.
Sometimes some clients say that their credit's bad, and it's really not too bad. Like they just are credit illiterate too. So.
Yeah, that happens a lot. Both ways too. I have people tell me, "Oh, my credit's great," and I pull and it's like a 670, which is, you can buy a house, but it's not great. But then I had, I worked with someone that we're in contract right now, and she said, I think my credit's not going to be very good. And I pull it, and I'm like, what are you talking about? Your credit's perfectly fine to get a house. So again, that just goes to the whole point of, if you have somebody who says they want you to show them a house, you have somebody who says, hey, I want you to be my realtor, get them pre-approved. Because again, until you dive in and find out their specific situation, it's just a guessing game. Nobody wants to be driving around with gas prices the way they are, showing houses if we don't know if they're approved. Makes sense.
And, I want to show of hands. Erica, you're not licensed yet, but how many, for everyone that's here, raise your hand if you would show a client a house without a pre-approval.
Be honest. Come on.
Heather says no. It depends on. Well, what is if you don't know them? Say it's a referral. Say, would you show a house and they're like, I'm early in the process, I haven't went to a bank yet. Heather says no. Courtney, what would you do? Would you show a house if you don't know them? It's like a friend of a friend.
There's no wrong answer.
There's no wrong answer. Yeah.
I might.
Oh yeah, what did you iffy?
I don't know.
Okay, if you don't, Katie, what would you do?
I would show one.
There we go. I'm with Katie. I show them one. So Erica, write this down. That's a great debate. I mean, we've debated that and for the history of mankind in realtor world. But if you have a client, I don't want to even say it's a client yet. It could be a customer if we get in semantics, right? But if it's, if it's someone that you have, I mean, if I look back in my career, like I have sales of people and they refer people, and I got them from the weirdest situations. It could have been like a postcard, a letter, just running them into them at something. And I think about like, gosh, think about what a wonderful relationship that I started with this person because they answered a letter I mailed to them 15 years ago or something like that.
Yeah.
So I'm more like Katie. I will show them one house, and say, okay, well, let's take you out to a house. I'll show you around and then just see if this is something you really want to do, because then once you get them out there and they look around and I'll say, well, what do you think? I mean, do you think you'd want to buy a house? I mean, what do you think about all this? And if they say, I think I do. You don't need to show more than 2. I always say I give them one afternoon of my life. That's what I always say. Like, you got one afternoon. Like, if you don't know, looking at a house or 2, like if this is something you really want to do, then like you just need to sleep on it, But usually when they go out and start looking, they say, oh my gosh, this is wonderful. Okay, well, next step, let's just talk to a lender. You don't have to do anything, but let's just talk to them and see how much your payment would be. And like you baby step it. I've had people who've told me in my career that said, I talked to this agent, and no offense to the people that said no, but they said, I talked to this person and I said, hey, can you show me a house? And I told them I was a pre-approved, and they literally almost hung up on me. Now, I don't think the agent hung up on them, but they just kind of felt like they didn't want to give them a time of day. So I don't know. It's a slippery slope. It's your business. You do what's best for you. But I always give them one afternoon of my life.
I think it also depends on the market too. I mean, if this was a year ago, most people are not want to go look at one house. They're good. Hey, here's 5 houses. Can we do this Sunday? You know what I'm saying? Right now, with the market being a little bit slower, you probably have a little bit more time on your hands. Sure. And again, there's no wrong answer. You do whatever you feel comfortable with. I agree. I mean, one afternoon, one house, sure, but I wouldn't be going out doing 3, 4, 5 if you don't know anything about it,
Yeah.
But again, you do whatever you feel comfortable with, and however you want to spend your time is how you want to spend your time.
So I'm really interested in this topic. So if anyone, put comments in below, say yes, I would show them a house, or no, I wouldn't show them a house. So I'm kind of interested. I don't know. I mean, I don't know if it be 50-50 or not. But
There's no wrong answer.
Yeah, there's not. It's up to you. And I think every broker that you ask will say, well, it's up to you. It's your time and your gas money, So, but I would be interested if you, comment below if you would show them a house or not without a pre-approval.
Yeah.
So, all right, go ahead, Don.
Yeah, no, that's it. So that's the pre-approval process. Once they go into contract, obviously you'll want to give me a call, or usually the buyer is super excited, so I'll get a notification from them. But once you're in contract, once it's fully executed, you'd send it over to your lender. Okay. I then call the customer to go over all the contract information, make sure everything's correct, from the address, the purchase price, if there's any seller concessions, closing date, all of that stuff. I then express the importance of getting me the documents in a quickly time fashion. Want to try to get you clear to close as quickly as possible. So I let them know again, this is where things start to move fast. You're going to get all types of communications there's computer generated emails coming from the lender. There's emails coming from me, phone calls from me, the processor. Your agent might have questions. You have to drop off the due diligence check, the earnest money. So it's lots going on. Okay. I let them know I'm there for them throughout the entire process. If they have any questions, to reach out. But it's extremely important to pay attention to those communications, because if you want to close on that closing date, this is a 50-50 relationship. It's not just the lender. I need you to get me the stuff when we ask you for the stuff. You can't get an email and a phone call from me saying, okay, let's go over what we need, and then you send that stuff to me 10 days later. That will affect your closing. So that's expressing how important that information is. I also let them know, like, hey, we talked about this during the pre-approval process, but it's even more important now once you're in contract. Don't go spending money. Don't go opening up credit cards. Don't be maxing out credit cards. Don't go buy a new vehicle. anybody who's been doing this business long enough has had that problem. Has had up. And I had an agent last year. He said that this customer of his rolled up to the walkthrough in a brand new truck, and he said, "What's that?" And he knew that. And that's one thing I do too. Is if your ratios are extremely tight, I'm not going to tell you what you want to hear. I'm going to tell you like this is what it is. And his ratios were extremely tight, and he went out and got a new truck. Killed the whole deal. We had to walk away. So anyways, I expressed to them how important it is not to go spending money. And then I'll review the numbers. Once I have an address, like when I go over numbers with a customer, they're all estimates up until closing actually. But if I don't have an address, I don't have taxes and insurance as I can guess it and can get pretty close. But once I have the address, I can put in the address to get the property taxes, the insurance, go over the cash to close, the estimated payment. And then we talk about the appraisal process and how, you have to get the house appraised and how do you want to pay for that appraisal? My company, I have some leadway with this, some discretion with this. If things look good, we could roll the appraisal into the amount of money and do at closing. Some people don't like to put $600 on a credit card. I get it. So now if they don't buy the house, they're still going to pay for the appraisal one way or the other. But this gives them an option to where they don't have to put it on a credit card.
Is that for FHA or conventional or any loan that you can wrap your appraisal into the mortgage?
Well, you're not wrapping it into the mortgage. It's for any loan, okay? But and this is going to be not the same for all lenders, okay?
Okay.
So with me, I can roll it into when you come to closing, that bottom line that's due includes the appraisal.
Part of your down payment.
Yeah, part of your down payment.
Got it.
Some people just don't like to rack up credit card debt. I get it. So there's that option. And then I send a real estate report card. This is a service that we have access to. I don't know if you probably can't see it online. But this is something that all my clients get when they go into contract. It just makes the buying process more real to them. It's got a lot of great information about the area they're buying in, the employment, affordability index, how many homes are being built, just things like that. It's just something nice to have. And then I do a weekly check-in call, if not every week, every 10 days, just kind of let them know what's going on, ask them where their documents are at, just kind of get an update. How's it going? Just checking in with them. Ask if they have any questions, concerns. And then I also do a referral for the agent. So I'll ask the client, hey, how's if Toya is our agent, how's Toya doing as your agent? She doing really well? Okay, great. They always say, yeah, it's awesome. She's great. Well, hey, Toya makes a living selling homes. So if you have any friends or family members looking to buy a house, Toya would really love a referral. So I think that's really important. Try to push that because you guys don't. A lot of people don't ask for referrals on their own. So it's really big for me to try to push the referral for the agents that I work with. So that is the in contract process. Any questions on there, Adam?
No, I think the biggest thing is I know that sounds stupid, but tell your clients when they get pre-approved and you're shopping for a house, don't put credit card debt, don't change your job. I know that sounds stupid, but a lot of people will start buying crap for their home before they'll start buying couches and furniture to get ready for the new house. And then that could throw their debt to income out of whack. So I know it seems simple. Like, why wouldn't people understand that? But they don't.
Yeah, they don't. They have a lot going on. Again, it's when you're buying a house, you got the stress of buying the house, but then you got your normal life. So I get it. This conversation I have with people is 30 minutes or so. I'll send an email with all that information in there, and then even in there are some do's and don'ts, and it specifically says like don't change jobs, don't buy stuff. But people still do. But at least we tell them not to. So that's that part. So and then we talked about appraisals a little bit. And I think we actually hit on all this stuff. But Most lenders do require the customer to put the payment on a credit card up front. I don't require that. And again, it's because a lot of people don't, want to put $400-$600 on their credit card. So we talked about how FHA appraisals are more strict than conventional. VA appraisals do typically take longer, as Sam will tell you. VA takes longer with everything. Everything that the VA does, they go at their own pace. So, they have up to 10 business days to go out to the house and appraise the house. And this market probably isn't going to take that long. I think we got one back pretty quickly, but if things are humming and things are busy, they can take the full 10 business days before they even have to appraise the house, which again, if you're trying to close a loan in, 20 days or something, that could be a problem with a VA loan. And it like we talked about before, even if you don't get it, you got to pay for the appraisal, but that's pretty much on the appraisal. I think we hit on all that stuff with your questions.
I have more questions.
Oh, okay. Do you? All right.
So how long does it take for a conventional loan on average, like industry standard?
The industry standard is, 30 days, but most lenders, including myself, again, if it's a clean loan, the customer gets the documents into me quickly, we can do it less than 20.
What about FHA?
Same thing. Industry standards is actually probably 45 days, but again, most lenders can do 30.
What about VA?
Same thing. 45 would be industry standards. Most lenders can do them 30. I can do them in 30. Less than 30.
Why does the VA and FHA? Because that's another issue. Like when the market was super hot, when you would, it was a seller's market. So when a buyer would come in and have an FHA loan, they would be like, well, it might take me up to 45 days to close. And they'd say, gosh, that conventional loan will close in 30.
Yeah.
Right? 30.
Right.
So, or 20, whatever it is. So why does an FHA loan and a VA loan take longer?
Well,
FHA.
That question. Yeah. So FHA and VA are the government. Anything you've ever done with the government does it not take longer. That's just the honest to God truth. You're dealing with the government.
When you say dealing with the government, what do you mean?
FHA and VA are government loans. So they have, like we talked about, the appraisal, the pre-approval process. There's more requirements. Appraisal could have issues. When you're doing the VA, there's more. The easiest way to put it is there's more checkbox to do on a VA and FHA loan. There's more things a lender and a buyer has to do that process. So that's typically why those will take a little bit longer. However, with the market the way it is now, again, myself included, we could do these loans earlier than 30 days. But then if it starts getting super busy again, hopefully, then you'll probably see those times push back, especially the bigger banks like the Chases, the Bank of America. So I worked at Chase for 13 years. We couldn't close a VA loan in under 90 days. FHA loan 90 days. It was crazy.
So if we are writing contracts and we have an FHA client or a VA client, how long should we write the contract out?
It's a great question. This is a conversation that we would have when I get them pre-approved, or if I look at their loan, call me and we'll talk about it. But my answer is typically going to be depending on that specific customer. If that customer is a W-2 employee and decent credit, then I'll say write it for 24 days. If it's an FHA loan, we'll knock it out. If there's some hoops to jump through, I'd say, let's write it for 30, 40 if we need to. I haven't closed a loan because of a customer longer than 40 days. I've had sellers ask for that time frame, but you can typically, if a lot of the hard work is up front, I don't say hard work, but a lot of the leg work is up front. Right. So that's the pre-approval process we talked about. So as long as you go through that, have them fill out the application, have them have a conversation, you're going to find out a lot about what you can do when you write a contract. So that's a conversation I have with the agents when, they get into contract. If they're asking me, how long should it be? But typically I tell them, hey, I got them pre-approved. Everything looks good to go. Make sense? Yeah. In this market, I wanted to talk a little bit about seller concessions. Some of the contracts I'm getting, running into people, sellers giving out money to go into contract, which is awesome. It makes it, great for buyers. But there are some limitations, and you're usually going to run into more issues on lower loan amounts. I had a contract last week. It was like 130,000 and the seller wanted to give like $5,000 and they couldn't because on primary and secondary homes, if you're putting down less than 10%, you can only get 3% max of the purchase price. Okay. So, or the appraised value, whichever is less. Meaning if the house came back appraised less than the purchase price, but then most of the time you're gonna adjust that purchase price if the appraisal comes in lower. But you can only get 3% of the purchase price as a seller concession if you're putting down less than 10%. So there's a cap on what they can give you for seller concession. Do you put down to yes, ma'am?
On seller concessions with VA loans, can the sellers pay like all the fees for the buyer when they're doing the VA loan?
Yeah. So
I was going.
Yeah. So the question is can a VA loan, can the seller pay for all the closing costs? Yeah, they could pay up to 4%, which typically that should typically cover it. But that's a great question because you could have a veteran, okay, do 100% financing. And let's talk about 100% financing when I say that. USDA and VA loans when I say 100% financing. That doesn't mean you can come to closing with no money. Like people think, oh, 100% loan amount. There's no money due at closing. Wrong. You have closing cost and escrow money. Escrow money is for taxes and insurance. We'll talk about that in the next slide. But on 100% financing, typically, and this is an average, but I'd say closing, you're coming to closing with $5,000 to $8,000, let's say. Or a USDA loan, because depending on where you're buying, what the fees are, there's, that's what's going to be due at closing. If 4% allows the seller concession, then they could technically pay for all of that and technically come to closing with no money.
So if the house is a $200,000 house, they basically could give them $8,000
in fees.
Seller concession or
right, and then
closing costs.
Yeah. That's a great. Did that answer your question? Okay, great. All right. And then FHA USDA up to 6%. So conventional, I guess you want to talk about pros and cons. I mean, I guess the only con is on a seller concession, you can get more on an FHA loan than you can on a USDA loan if you're putting down, less than 10%. Does that make sense?
So if you put 25% down on a conventional,
yeah,
the seller can give you 9%.
25% down or more. Yeah.
Wow. Okay.
Yeah.
That's a lot.
It's a lot of money.
It's a lot of money.
Which, by the way, the seller concessions, I think I put down here, they can only be applied towards fees and escrow money. They can't be applied towards the down payment. So you get someone that says 9%, that's great, but is there 9% in fees? Probably not. Unless you want to spend a bunch of money on points to buy the rate down. Yes?
So say a buyer qualifies for a conventional loan, right?
Yeah.
The down payment is more, this, that, and third. Can you switch them to a FHA loan?
Yeah.
Like in the process to save some money?
Yeah. So the question was, let me make sure I say this right. You want to know if you could switch from conventional to FHA to get more money on the side, to save your client some money. Yes, but then we have to look at their specific situation because there was a reason why we went conventional versus FHA. So we could definitely run those numbers, but it's going to depend on, the rates are different. PMI calculation's different. There's a lot that goes into that. I would still tell you most of the time that 3% should cover what you need. The fees are more expensive on FHA. There is we talked about it with VA. The FHA has a funding fee also. I don't remember if we talked about it, but there's a fee that the government charges in order to take advantage of their FHA loan. And it's a hefty fee. It's like 1.75% of the loan amount. They allow that fee to be rolled into the loan. Now, as an agent, I wouldn't recommend having that conversation with the borrower because then that's going to open up a can of worms and more questions. That's something that I go over with when I talk about the FHA loan, pros and cons. So I'll explain to them the fee, how much it is, and such. Yes, Toya.
Is it true that also an FHA loan, the PMIs for the life of the loan?
Yeah, that's true. So the question was, is FHA PMI for the life of the loan? It is. Unless you do, I think, a 15-year loan. No one's doing a 15-year FHA loan. So, but yes, if you're doing a 30-year FHA loan, the PMI is going to be on there for the life of the loan until you refinance out of it. The only other situation I think, and I have to Google it, but I think it's if they're doing a 15-year loan and then or if they're doing 30 years and putting down 50%, it goes away after 10 years. They're not going to have an FHA loan that long. So they're going to have the PMI on there for the life of the loan, which is another reason why I wouldn't recommend going from conventional to FHA to try to get the 6%, because you probably won't need the 6%. Does that make sense? Okay. So I wanted to talk a little bit about escrow, give you enough information to just kind of be able to answer some of the customers' questions. This actually comes from my customer service days. Like I said, I was at Chase 13 years, and my first 2 years I was in customer service. That's kind of like my background with sales. Never really said myself as a salesperson. I like to service people. I think learning escrow helps a lot because it is complex, and there's a lot of confusion and misunderstanding about escrow, not just when they're buying the house, but also when they're in the house. So escrow accounts can be waived on conventional loans with 20%. That's important because people will ask you, like they'll hit you up and say, hey, can you give me an estimate on a payment on a loan amount of $250,000? Or they might have went online and did the math themselves, but there's an escrow account. There's an escrow account is a set of money for monthly taxes and insurance, okay, and PMI. So you have to take that in consideration when you're calculating payments, which is typically anywhere from $300 to $800 more a month when you add it to the mortgage, depending on where they're buying. But I get asked a lot, well, I'm just going to pay for the taxes and insurance on my own. No, not unless you're putting down 20% on a conventional loan. If you're doing an FHA loan or a USDA loan, you can't waive it at all anyways. Put down 50%, doesn't matter. You're still going to pay for taxes and insurance on those loans. An escrow analysis is performed once a year, and adjustments are made based upon that prior year. So what that means is, when I worked at Chase, customers would call in, they'd say, hey, you just bought my loan from Bank of America and you jacked my payment up. We didn't jack your payment up. We did an escrow analysis, and we did that for your benefit. We wanted to see where your escrow stands when we got your mortgage. We wanted to see if you're in good standing or not. So when you're talking to customers, you want to ask them to look at their monthly statements and pay attention to their escrow balance. So again, these are just like conversations when you talk to customers. They're going to ask you about home ownership and what should I do and what should I expect? And this is a good nugget to share with them. Like, hey, listen, your payment can always change. It can always go up or down, and it will always go up and down. Your payment will never be the same year in and year out. Even if it's changed by 20 cents, it's always going to change. And it's based upon what happens with your property taxes and insurance. What do taxes do? Always go up. So your payment's going to always be adjusting. So, and it's important to look at your monthly statement, because if you notice that your escrow balance, there's always a 2-month cushion. Okay. So the easiest rule of thumb is look at your escrow, monthly escrow. If it's $200 a month, then your escrow balance should always have $400 in it. Okay. If you ever see it go down below 400, don't panic. Call your mortgage company and just say, hey, listen, I noticed that it's less than $400. Should I be concerned? What happened? Oh yeah, your insurance went up $300 for the year, and they'll tell you how to correct that. But there are instances, and I've seen hundreds of them, where the escrow account is severely negative, and that's a tax abatement came up, forced placed insurance. You also want to tell them to pay attention to their mail. People don't pay attention to the mail. Mortgage companies, sometimes they make mistakes. They collect money to pay for the taxes and insurance. Sometimes they send the insurance to the wrong company. If you switch insurance companies and the insurance company didn't tell the mortgage company, that could cause a problem. So if they have forced placed insurance, the insurance will double, triple sometimes. And then the customer won't even know until the escrow analysis is ran. Imagine if that happened 2 months after buying the house, 3 months after buying the house, there's 7, 8 months later, they get an escrow analysis. Their payment went up $600 a month. It's a storm. So
What percentages of people have an escrowed property tax? For those who don't know what escrow is, it's just an account that you pay every month into to pay your property taxes.
yeah, it's part of homeowner.
Insurance.
Yeah, it's a part of home ownership.
How many people that have the option opt out of it?
Not very many. Out of the people that I do loans that put down 20% or more, I'd say 1 in 30 maybe
Really?
ask me about it. It doesn't come up too much. Yeah, just because it's convenient. Nobody likes to write a check at the end of the year for several thousands of dollars for taxes or insurance.
And there's no extra fee to do it.
Yeah, no, there's some misconceptions. Yeah, people are like, well, you hold on to that money and make interest on it. No, the mortgage company doesn't. The mortgage company puts it in a non-bearing interest account that sits there, collects money, and they just pay out taxes and insurance when they're due. So that's, yeah, I always tell people I would recommend having an escrow account. If you put down 20% or more, I would have an escrow account. It's just one less thing you have to worry about. Yes, ma'am.
Why would you want to waive an escrow account if they have a commission loan?
It's a great question. I mean, I've talked to people that, and usually those clients are the clients that have. Oh yeah, I'm sorry. Yeah, I'm sorry. Question is why would someone want to waive their escrow account if they're putting down 20%? And the answer is it depends on the individual person, but usually in my experience, my personal experience, when I was working at Chase and I was in the servicing department, and doing loans, most of those people that wanted to waive their escrow account, they had lots of money, they were really good with investing, and they watched their money like a hawk. They were knee deep in their investments and wanted to control everything. So you don't have it happen a lot, but new homeowners don't know about it. So they're going to think that they can buy a house for, like, I had someone the other day who has a bunch of money saved up. He makes like $40,000 a year. And he said, I'm going to buy a $300,000 house. And my payment's going to be $800 a month. I don't know where he got that from, but I had to somehow, kindly tell him that's not going to happen. And it kind of show him why. And then when I started talking about escrow and stuff, he looked at me like I had 3 heads. He'd never heard of taxes and insurance on a house. So these are things that, again, you might never talk about it. I think it's nice to have in your back pocket. Just say, hey, don't forget, when you're looking at payments and stuff, you got taxes, you got insurance. I think that'll help, make them understand that there's other payments involved, other dollars involved in buying a house. And then also HOAs and condo fees, they're not part of the escrow. Okay. So if someone buys a condo, I'm going to quote them a payment. I'm going to ask them what their HOA payment is. Okay. That goes into their debt to income ratios. I got to count it against them for their debt to income. But I'm going to let them know, like, hey, listen, your payment for your mortgage is this, but then every month you have to write a check to the HOA or the condo association and pay them separately. And even if they said, hey, well, I want that to be part of my escrow, you can't make that part of your escrow. So, and then I also said, I don't know, some people don't know this, but insurance is paid up front for the year at closing. So when you buy a house, insurance is paid for up front. You're paying for the insurance up front. So 12 months. So I have people ask me, why are you collecting 14 months of insurance on the loan estimate? Because you're paying for the insurance up front. And then I told you have to have a 2-month cushion, right? So you have 2 months of a cushion for the insurance. So that's it on escrow. Any questions on escrow?
We have some that's coming through the chat.
Yeah.
So let's do Nikita Wilson asks, can you explain what it looks like when an appraisal is waived? Is there instances where you're buying a home and they waive the appraisal? Yeah,
great question, Nikita. So there's a database, a system. We'll run it through once you're in contract. We'll run it through with the address in, And a lot of times, if your customer has great credit, they're putting down, a chunk of change, it'll tell you if the house is appraisal waived eligible. And then, so I'll tell the client, hey, listen, great news. You don't need an appraisal done. And then, I've had customers say to me, I still want an appraisal. They got to pay for it. It's just the same thing. But if it's eligible for an appraisal waiver, they can have their appraisal waived. And that's one less thing you got to worry about.
Do they pay for the
No.
appraisal if they're waived?
No,
Oh, right.
don't get that far yet. We're not going to, we'll know before the appraiser goes out to the house. You know what I'm saying? And then we'll have that conversation with the borrower and just say, hey, listen, you don't have to, where you're buying, the comps are good. The system, it's a system, this database based upon your specific situation is saying that you don't need an appraisal. And then, again, I've had people say, well, I still want an appraisal. That's fine. You can do that.
Really, they still won't.
Yep. I've had that many times. Yeah.
And they pay $500 for it.
Whatever it is, they pay for the house to be appraised. They want it appraised. Yeah. I mean, and then I would also, as a loan officer, I'm going to call the agent. Hey, listen, great news. House is eligible for, appraisal waiver. I let your client know he still wants an appraisal. You might want to call him and tell him that's maybe not a good idea. It's not a good idea, I think, just because, if what happens if there's something wrong with the house, is not something wrong, but like sometimes these appraisers and underwriters can be super picky about something and then just open up a can of worms. Okay. If you're comfortable with the house, you're comfortable with the price you're paying, what happens if the house comes back appraised, $10,000 less. And then now you're trying to discuss, anyways, that's a conversation I have with the agent to see what they want to do.
Nikita had a piggyback on that.
Okay.
And then she said, well, can we put that in the offer to make the offer more attractive? But we wouldn't know that they would waive that.
Yeah.
Down
Typically, but there's some, if you have, and I'd have to check with my company, with us, but I know that there are some databases that you can put that in to see the likelihood of that. It's not common. I wouldn't recommend that because, again, here's the other thing too. So as the process moves, right? So underwriters reviewing the file, you're in contract, things are going great. Customer goes out and does something. Buy something we told them not to buy, and their debt to income goes from 38% to 46%. We can still do the loan, but then that system, if it picks that up and says, okay, now we need an appraisal, or if there's something that happened in that area, if it says we need an appraisal, then now we need an appraisal. That appraisal waiver has to carry throughout the entire process. We don't just run it one time. I say we, I'm talking about lenders. Lenders don't just run upfront one time. It's a whole process. So I would not advise that, but if you want to get creative, do what you got to do.
All right, we got another question. CC Beck asked, is FHA or conventional? Is FHA or conventional or both for under 10% down payment?
For the seller concession?
No, I think if someone has under 10% down payment, you can do an FHA for sure.
Okay.
And then a conventional. You have conventional.
Yeah. So conventional. Great question. The conventional you can go is if it's a first-time home buyer, 3%. Okay. If they haven't owned a home, I think in 3 years, they can still be considered. So if someone sells their house, they say 4 years later, I want to buy a house. That's technically a first-time home buyer again, 3%. But most of the time, if they're not a first-time home buyer, it's 5% minimum for a conventional.
Okay, 5%.
5%. Yeah. FHA, 3.5%.
And then when she asked the next question, when transferring from an FHA to a conventional, so it'd be maybe a refi.
Okay.
Will a new appraisal be required if already completed?
I think she might be asking. Well, if it's let me see if I can answer this. If it's a refi, yes. Okay, you'll have to get the house appraised. Unless now again, I'll tell you now, I've done loans where someone had an FHA loan for like 8 years, and then they finally decide to refinance, take advantage of the lower rate. You run it through, and it'll come back and say appraisal waiver. So you can get an appraisal waiver on a refi, going from FHA to conventional, or even conventional to conventional. Depends on the time of the system and what's going on. I don't know if she's asking about.
I think she's asking the opposite. And CC, type in there if I'm getting it wrong. It says in the same transaction.
That's what I think she was asking. Earlier we were talking about, I think Heather said, hey, if I want to try to save money, if I want to try to get better seller concession from,
FHA
yeah. So it's a different, if it's a different, yes. So you might have to have another appraisal done. It depends on the appraiser if they're licensed to do FHA.
Right.
It's two different.
Not all appraisers are licensed.
Right. So yes. Does that answer? I don't know if that answers her question. I hope it does. Ask her. Cece, does that answer your question?
She'll try.
Okay. So I think that's it.
Good info though. Good info. Thank you.
Any other questions on escrow? Does that make sense to you guys? I know I talk super fast. There's a lot of information. So yes, ma'am. Yes, Heather.
On an escrow account, is the escrow account the same thing as like, so earlier we were talking about, you kind of like brushed over it real fast. So like, somebody's getting an FHA loan and there's work that needs done to the house, but they want to do it later. They can put the money into an escrow account, right?
Yeah. So the question is this escrow account the same as when you're buying a house, trying to fix stuff and putting that into an escrow account? The answer is no. It's two different escrow accounts, right? So this escrow account I'm talking about is they're buying the house or they're in the house, and this is the money that's set aside for property taxes and homeowners insurance. The escrow account you're talking about is like there's these escrow holdbacks where, let's say you're having a house built and it's winter time and they can't put the sod down. So they'll hold back $5,000 to put the sod down in the spring. You can do something like that. Okay. But let's say you want to get a new roof done and the seller's like, well, I'll put $10,000 in an escrow account and then we'll pay for the roof later with that $10,000 out of that escrow account. You can't do that. If that was like, if the appraisal said, hey, this needs a new roof now, or you can't, it's subject to a new roof. The roof has to be done before the closing. So does that answer your question? Okay. So yeah, two separate escrow accounts with like the same concept. Like it's an escrow account is basically a place where money is held to pay for something. And that's with this stuff. This is just like their monthly bills and things like that. I'm trying to think if there's anything else I want to talk about escrow. I think that's it. It can be really complex. I mean, especially I have customers still to this day that I talk to at Chase that have my cell number, and they will call me when they get an escrow analysis. These escrow analyses are usually like 4 pages long and has every transaction on it. It can be really confusing. But I just let them know when they're buying a house, hey, listen, this is your estimated payment. We're most likely going to, lenders are going to sell the loan to a servicing mortgage company. A servicing mortgage company is like a Chase or a Bank of America, whoever. When they get it, they do escrow analysis. It's for your benefit. They're going to look and see if your taxes and or insurance have gone up. If so, they have to adjust your monthly payment. So pay attention to your mortgage statement. Okay, that's it. And then just be cautious of that. Just look at it, make sure you know what you're looking at. And if you have questions, they can always call me. I'm pretty good with the escrow stuff, but they'll get, way more in depth if they call their lender to go over it, because it's all right there in front of them. Okay. Hybrid closings. So now we're at the closing part. My company has access to this thing called a hybrid closing. It's super neat. Most of the loans will qualify for it. It's a streamlined option. And basically, in a nutshell, what it does is like, I'm sure you guys have been to closings. You sit down at a closing, you're there for an hour, you're getting carpal tunnel, you're signing 100 pages. This does away with that. It reduces in-person notary time, cuts down on signatures 90%. You can't, it's not eligible for loans closing in a trust or a power of attorney. That doesn't happen very often. And non-occupant co-borrowers cannot e-sign. They have to hand sign everything. So there's a couple things that'll make it not eligible. But most of your clients will be eligible for something like this with us. And they just have to know, and this is something I go over with them as well, is like, hey, listen, on closing day, first thing in the morning, you're going to get an email. Open up your email, e-sign those documents. And what they're doing is, instead of sitting down and hand signing the closing docs, they're just pushing their mouse button where it says signature. It's way better. They got to do it the same day of closing, because there are some docs that have to be wet signed. I think there's like 6: the mortgage note, the closing disclosure, the right to cancel, any notary documents. Some government loans require certain documents, but I mean, you're talking about saving a ton of time for the customer. And they usually just dread closing day, where they have to sit there and take time off of work and sign documents for an hour. And so that's really cool. So any questions about that?
How long does it? We have some more questions coming through, but
Yeah.
How long should we tell our clients a closing? Because they'll ask that, like, oh, I got to take off work. You were like joking about it. How long should they anticipate a closing to take?
I've been told an hour on the old way, right? The new way, you probably, I mean, depending on what questions they have and things like that, they can knock it out in 15 minutes, probably. I mean, pretty quickly. If they got a lot of questions about the documents and things like that, that's fine. Just takes a little longer. But I think the main part is they don't just like, nobody likes just signing and then the notary's like the next page, the stack's this big, and then they're just doing this. That is now going away. So what are the questions you said were coming through?
We do. Carly Jones asks, is the process different? I think she's meaning from the lending process, different buying an existing home or compared to or a new build or new construction?
The pre-approval process, the whole process.
I think she means the whole process.
It's not much different. I mean, from a lending side, there may be a couple of things that the underwriter is going to ask for as far as additional documents, or certain things that they may want. But as for, from me on a loan officer side, no, I'm going to talk to them the same way and go through the same process as a typical loan.
Okay, pretty simple. Next question is, can a seller do an allowance for a roof or windows in an agreement and not have it escrow?
No, I mean, that's a fancy word for escrow, I think. You can't, if there's anything that you guys agree on to be fixed, let me put it this way. When
Not
I get,
not bank mandatory, basically.
yeah, you'll want to have certain conversations outside of, like, you don't want the lender to know about, you don't have to tell the lender everything. Like, so one of the things, if I get an addendum, right, and someone sends me an addendum, seller to give $2,000 to fix the mold in the basement, I'm gonna call the agent and say, hey, look, can you do me a favor? Can you just maybe put $2,000 seller credit? I don't need to know. And again, I'm not trying to just be really basic with stuff, because there's certain things we don't need to know about. I'm not trying to tell you to hide it. I'm just telling you, we don't need to know every little thing that's going on. So yeah, TMI. So just keep it short and simple. And then, my rule of thumb, and like a lot of people will say, well, I'll send you my tax returns. And I said, if you're self-employed or you own investment properties, I'm going to need your tax returns. But 90% of my customers, I tell them, do not send me tax returns. Let me send it to the underwriter. Let the underwriter tell us if we need tax returns. I want the underwriter to tell me if we need additional things. It's not because we're hiding anything. It's just, if you're buying a house, again, you have life, you have your family, your job. I don't want asking, if the underwriter sees something, it opens up a bunch of questions that the underwriter wants answered. You just want them to kind of explain it to you. But to answer your question about that, no, you have to, anything that you agree on, especially if I'm the lender and I see that seller's gonna, pay for a new roof, you gotta have that roof done beforehand. Now, whatever you do outside of closing, you don't tell us. We don't know about. Make sense? All right, finishing up here. A couple common questions. Again, I get a lot of, and the main reason I reached out to Adam about this is because I do get a lot of his team calling me, texting me with questions, and I love it. Keep them coming. I love working with you guys. You all have been great. but I wanted to get this out there to hopefully answer some of your questions. But some of the common questions I get, if there's a limit for a mortgage, like I can't remember if it was one of you guys, but someone thought that this 70-year-old woman couldn't get a 30-year mortgage because how old she was. And that's not true. You can be 120 and get a 30-year mortgage. You can't tell someone they're too old for a mortgage. You do have to be 18 years old to get a mortgage, but there's no age limit to get a mortgage. I get this a lot. Can I use mattress money for a down payment? Hard no. Okay. Right, Heather? Hard no. No, but no, sir. I mean, certain customers, I mean, they'll hold on to cash and then, say, hey, yeah, I got money to put down. And then, oh, great, send me 2-month statements. Well, it's in my safe at the house. That's a problem. You have to source it. So one of two things in that situation, they can go deposit the money into the bank and then we can reconvene in 3 months because I need 2 months bank statements, all pages. Okay. So so I need 2 months. So if you deposit January 15th, okay, I can't see that deposit. So I need February, March bank statements. So we're talking in April. Okay. And I'm not trying to tell people to do, like, there's nothing wrong with that. I mean, people save money, people sell stuff. The only other option is if you can deposit it, but then we got to trace it. We got to find out where that money came from. You sold a $3,500 Buick, then I need to see the deposit. I need to see the receipt. I need to see, there's all kinds of crazy stuff the underwriter's going to ask for. Bill of sale. They're going to want proof that Buicks are going for that much. I mean, you have to be able to source every single dollar. And that's even in the case where if we're doing a loan and I get 2 months bank statements, I had to look. I think it's 20 or 25% of your monthly salary. If there's a deposit bigger than that, they're going to want to know where that came from. Okay.
This is for anti-money laundering.
Yeah. I take a class every year, anti-money laundering laws. So any money that is deposited, you win $2,000 at the casino and deposit that. If that's a certain percentage of your income, that we can't use it. So we got to be able to track every dollar that, again, I think it's 20, I can tell you later, but it's like 25% of your monthly income. It's not a lot. I mean, you might have, a couple bottles of bourbon worth some money. And if you sell it to a friend and they deposit the money, if it's, $4,000 or $5,000, next thing you know, they're going to be like, hey, where's this money coming from? Oh, I sold a bottle of whiskey. What are you talking about? They're just like, what are you talking about? So, yeah.
That could really happen.
It could. So, and then I get asked a lot too, will getting my home appraised cause my taxes to go up? No. So you'll hear a lot of buyers and people who own homes. They'll ask, they'll say, hey, I got a letter saying my house is appraised and my taxes are going up. That's a county assessed appraisal. That's not a mortgage company. Mortgage company can appraise your house 5 times in a year. Your county's not going to know or care about it. They have a system that they use. It's a mass appraisal computer software that does all that on their own schedule. So that's not an issue. And then this is a common question I get asked a lot. Will having my credit pulled again hurt my score? So I have agents call me and they'll say, hey, I got this customer. I want them to talk to you. They had their credit pulled and they just don't want to have their credit pulled again. So here's the story on that. Credit bureaus understand when you're buying a house that you're probably going to have 2 or 3 mortgage lenders pull your credit. Don't want to have 7 or 8, but they understand 2 or 3. The bigger problem is you apply for a mortgage, then you say, I'm going to open up a Home Depot credit card. There's a really cool boat I want to buy and a motorcycle. You start applying for all sorts of different credit, then the credit bureaus are going to be like, what is this person doing? And then that's when your stuff just starts tanking. So having your credit pulled after you had someone else pull it, could it affect it a couple points? Sure, maybe, but it's not going to affect it to where you're going to drop, 50, 60 points. And now we have a problem.
We got another question.
Yes.
Can you discuss gifting funds? So you
Yeah.
have a buyer that wants to buy a house.
Yeah.
Can the parents help them out? Or
Yeah, great question.
Neighbors, uncles, sisters, brothers.
Yeah, absolutely. So as long as it's a family member, you can be gifted funds.
Define family.
Well, That's a great question. So, typically it's going to be like parents or grandparents, but on a case by case, if you have an aunt or uncle, those can usually fly. Those usually are going to be on a case by case. If you can't have, and there's certain loans, and I can look, but like FHA versus conventional. I tell you what, there's I have on that mortgage basics. Is this still showing up on here? No, it's not. I think it did say something about gift funds. Yeah. So this doesn't say what it's all, but you can use gift funds for not just the closing costs, but you can use it for the entire down payment. But it can't be like your ex-girlfriend. There has to be. I had someone, they were engaged, and we had to show pictures for how long they were engaged. This was like 5 years ago. Yes. Who was first? I'm sorry, I missed it.
So does the giftor have to prove where the funds came from?
That's a great question. The question was, does the giftor have to show where the funds came from? Yeah. So we're going to need 2 months bank statements from where their money's coming from. Yeah. Heather?
Why can't the girlfriend, if she can explain her money?
Okay.
Why can't she get the
Okay.
money? If
Okay.
she can explain her own money, why can't she?
The question was, why can't the ex-girlfriend give the money if she can show where the money came from? Listen, these guidelines are always changing. It depends on the type of loan, but I think with conventional, and I have to look at it because I don't really run into that situation where a non-family member is given $25,000 for a gift. Well, I will tell you this though, with gift funds. So how I tell people on the gift fund is there's a gift letter they have to sign, right? So the first time someone starts saying to me, oh, my parents are going to loan me some money, I stop them. I can't hear about any type of loan. You can't take a loan out for a down payment. You can't do that. You can use gift funds. Your parents will sign a letter saying that you don't have to pay them back, but there's gifts. So typically those gifts come from grandparents, family members. I think there's ways around certain gifts. But again, it depends on the product, the company. But just for a good rule of thumb is going to be family members. And then, yes, you have to be able to, your family member cannot use mattress money for the down payment to gift you. Because I know that was your next question. Yeah. All right, any other questions coming through there?
Can you talk a little bit about a 2-1 buy down?
Yeah, the 2-1. Yeah, those buy. So the question was, can we talk a little bit about the 2-1 buy down? So the buy downs became a little popular when rates peaked back in October. Rates were like mid 7s. They've come down quite a bit since then. I think they're like in the mid 6s. But what a 2-1 buy down is basically we ask the seller to pay for a decrease in interest rate by 2% the first year, 1% the next year, and then the 3%. The third year, you're back to the normal rate. So the best way to explain that is, let's say it was 7.5%. Okay. So the seller is going to pay the monthly payment difference. So you calculate that up. Okay. And all the seller is doing is giving a credit up front to pay for the difference in interest rate. So if the rate was 7.5%, your buyer for the first 12 months will be paying a payment at 5.5%. Okay. After that next month, or at the 12th month, the second year, your client is going to be paying on a payment of 6.5%. And then after the third year, they go back to the 7.5%. What's nice about that is rates are expected to continue to go down later this year, not drop, go down. Okay. This is gradually go down. So the thinking is they're not going to be in that loan 2 years from now. Their end rate is 7.5%, right? But if rates go down to 5.5%, why not refinance and take advantage of that? Does that make sense? Yes, Heather. She was first.
How soon can a person refinance?
Question was how soon can a person refinance? Listen, there are no prepayment penalties on most loans. Actually, probably all loans that are like conforming, conventional FHA, VA. But 6 months is usually going to be the rule of thumb for it to make sense. Okay. Because even if the rates, now again, if rates were to plummet, that's another story. They're not going to plummet. They're going to gradually go down. Okay. So once they make 6 payments, like everyone I've been doing loans for right now, I tell them, hey, listen, once you make your 6th month payment, I have a sheet of all the customers I'm doing, what rate they got, when they got it. I'll be reaching out to you. But if you make your 6th month payment, you want to call me to like revisit. If you haven't heard from me, then let's do it. But 6 months is what we're going to roll with. Yes, ma'am.
I have 2 questions. Does your 2-1 buy down follow your refinance?
Does the 2-1 buy down follow the refinance? You look like you want to say something, Adam.
You mean like you buy your house, you have the 2-1 buy down, and then you refinance it? Does that same principle follow the next loan?
Yeah, no. Great question. Yeah. So no, you're not carrying. So look at it this way. The easiest thing to remember about a refinance is you're buying the house back from yourself is the easiest way to explain it. It's a brand new loan. Anything on that last loan you had an agreement with or whatnot, it's gone. It doesn't matter. Your new loan is going to be based off of the new interest rate and whatever terms you agree to.
And the second part of the question is, how is a 2-1 buy down better than just asking the seller to drop the price a little?
Great question. So the question is what's the difference between a 2-1 buy down and just asking for your client to pay for a cheaper, closing cost credit? So I wouldn't say it's necessarily better. It's different. It's what's important to your buyer. So, again, I would say, if you're, let's just take $15,000. If it costs $15,000, $15,000 would probably save your client, if you asked off the purchase price, probably $90 a month. Okay. But they're still going to have that 7.5% rate, using the example back in October. Okay. Whereas if they use the 2-1 buy down, they can have a much cheaper payment because 2% is going to be cheaper than $90. So it just depends. And that's a conversation I have. I mean, that's a conversation I would have with the client. I'm going to tell everyone I'm talking to right now, because I subscribe to this thing called MBS Highway. If you've never heard of Barry Habib, the guy's awesome. He's super tight into the market, super smart. I got to go watch him speak live, super informative. And, he's projecting rates to, he said middle of May there should be some good reports coming out. They're going to make the rates drop even further. So, and again, when I say drop, people think I'm talking about like, oh, 3s again. We're not going to see that anytime soon. But the conversation I have with them is like, hey, listen, here's where rates are expected to go. Okay. If you make 6 months mortgage payments, we can refinance if the rate's 1% cheaper. My company right now, I can refinance you if you bought through me and we waive all the lender fees. So I can save you money on closing costs. So does a 2-1 buy down work right now? Does it make sense? Maybe not. It just depends on where rates are at today, where they're projected to go. So back in October when they were 7.5%, I was preaching the 2-1 buy downs for sure. Now they're in the low 6s, maybe not, but it just depends on what's important to the buyers. Is it more important to have a cheaper payment, or do they want to buy the house, cheaper? Like a conversation I have a lot now is, talking about, do we, when we offer on a home in this market, is it better to put seller credit or to go in with a cheaper price? Most of the people I talk to like the seller credit because it's less money they're coming to closing with, right? So, and their offer may seem more attractive if they're offering full price and just asking for 3% or even less. I mean, some people don't even ask for the full 3%. But a lot of buyers, and that's something you want to talk to your buyers about too. Hey, listen, if we put this offer in, what do I'm going to make the offer what I think it should be, but what's more, I think we can get it cheaper, but what if we ask for a closing cost? I can make your cash to close $4,000 cheaper. Would you rather have that, or would you rather buy the house $5,000 cheaper? Because again, if we're talking $5,000, $5,000 is $30 a month. So yeah, you knock $5,000 off the purchase price. It's $30 a month change your buyer's life? Probably not. So they're probably going to get more bang for their buck if you ask for some closing cost credit. And that's the market we're in right now. Okay. Once spring comes around, summer comes around, the market might be completely different. We might be having a completely different conversation. But right now, the buyers that I talk to, they appreciate less money coming to closing. But again, everyone's different. No wrong answer. To answer your question. Okay.
Anyone else have a question? You got one more. We'll do one more.
Yeah.
We're an hour and a half in.
Oh, I'm so sorry. I
You know what's
have
funny?
2 more slides too.
Don was worried. Oh, you do?
I do. I
Don
don't
was
have
worried. He said it'll take 10 or 20 minutes. I said,
Yeah.
oh, I bet it won't. So,
I was being facetious. I thought it'd be 30 minutes.
Well, let's keep moving through. But
Okay.
We have a question.
Yeah, what is it?
Another one is there max gift money? Like if you get a gift from a family member, is there a max? Can they give you 80% of?
Yeah, no, that's a great question. No, there's no max on a no. They can pay for the down payment. They can pay. Because they could use that money for the down payment and the closing costs and escrow money. So if they want the down payment to be 40%, then they can put down 40%. Just got to be able to show where the money came from. No mattress money.
No mattress money.
Yep.
Okay. Yeah.
I want to talk a little bit about co-marketing stuff. I know a lot of you guys are newer agents and you have full-time jobs. You don't want to spend a lot of money on marketing and whatnot. I've got this really cool process where we could co-market together. And there's access to hundreds of marketing material, stuff like rent versus buy. I've got brochures in there, first-time home buyer programs. I've done that with a couple of you. I think, Courtney, you signed up. Heather, I think I sent it to most of you guys. We talked about, I wanted to talk to you before I sent you the email. But I'll show you a couple of examples of what I'm talking about here. And you probably can't see them at home, but Whitney's done it and Deja's done it. So this is kind of like what it would look like. And there's hundreds of these, okay? But like this first one's do's and don'ts, tips for a smooth loan approval and close. So kind of like what I was talking about before, my email says some things to not do, like don't switch jobs, don't open up a credit card. This is a great way to stay in front of your clients. You can do a drip campaign, whatever. And this is free. This is all free, okay? You can print it off to a PDF, put it on your social media. And at the bottom, you'll notice it has my contact information, but it also has the agent's picture, name, everything. It's got it all down there. So this is a cheap way, free, to where you could have access to some flyers and stuff. I just find that beneficial for a lot of agents.
Free is always good.
Yeah.
Especially when you're new.
Yeah. So this is really cool to check out. If you're interested, hit me up, text me, email me, whatever. I'll send it to you. It takes 10 minutes to set up. Whitney, Deja, it looks like they've completed. I think Courtney, you may have done some of it, but it's not completed. But that's what it looks like when it's completed. You'll get your picture and all that stuff. I got a buddy in Georgia. He's a realtor. And what he does is he takes, I don't have it on here, but there's a rent versus buy. He prints off 200 of them. And he goes to apartment complexes, folds them up and puts them on the car windshield or in between the door. He's been doing it for years. And it takes an afternoon for him to do. And he just likes to do that. So, and we just walk around, I'll hand them out and talk to them. But it's got both of our contact information on there. It's super helpful. So that's a tool I have. Last thing is I have an affinity program. And again, I want to bring value to my agents that I work with. And so one of the things that I think would really help you out is if you know anybody that owns a business with 50 or more employees, if they have less than 50 and they're growing, we could get an exception. If you have any friends or family members that work in HR, this is a great program that my company offers. And I'll tell you in a second how it ties into you. But the employees and their family members get $2,100 in savings. So not only are their lender fees waived, our company pays for the appraisal. You're not gonna find a better deal for this, and they're not paying for it in the rate. This is the same type of loan I would offer someone off the street. If their company signs up for this, they get the same thing. They just save $2,100. It's a great way to get in front of multiple buyers and sellers. What I mean by that is what I did. I have a friend in Delaware. He's a realtor also. His wife owns emergency plumbing. Okay. We both went in there and presented something like this. We both stood up there and we sold it as a package deal. I'll help you with the financing. I can save you a bunch of money. And Brett, he's going to be able to be your agent, your go-to guy. And so they look at us, these 40 people looked at us as a team, and I'm their loan officer and he's their realtor. So if you know anybody that you can get in front of, I'll take you with me and we'll present it as a team. It's great. And the companies, what's good for the companies too, is that it retains their current employees and also helps with the recruiting new talent. So in their package, like when I worked at Chase, we had an intranet, and at Chase, you had deals of, what was it, Mickey Mouse? What is that? Walt Disney World. Yeah, you could go to Disney World, half off, cruises, cell phones. So this is kind of like what that is. This is where they could tell their new employees, hey, listen, you're looking to buy a house or refinance a house. If you work here, we'll save you money. So I think that's a great opportunity if you know anybody that fits in that bucket, to where you can get getting in front of 40 people who you tell them, hey, listen, I help you buy a house, could help you out a lot. So that's it. That's all I got for you guys. Any questions?
Any last questions for Don? So again, Don Dickson.
That's my quote.